Hello, everybody, and welcome to our webinar today. My name is Mike Hengehold, and today with me are two of our investment committee members, Doug Johnson, who is a regular on these calls. Doug is our senior strategist, and he chairs the investment committee. Also with us today is Dan Rinck. Dan is a research analyst with HCM and a market technician extraordinaire. As usual, if you have any questions, you can hover at the bottom of the screen and there will be a Q&A section. Submit questions there and we'll try to get to them at the end of the call. And so really with no further ado, I'd like to let Dan take it from here. Dan? Yeah, let's do this.
So to start off, we really want to check in with where the market is so far this year. We have had this pretty brutal bear market. And as you can see on this chart here, we've had a lot of rallies throughout the year and we're currently in one. So we're looking at this chart and knowing that the market has to decide, is this going to be another bear trap or bull trap in the whole market rally? So if we look at year to date in bear markets, you can see we've had many rallies throughout the year. We've had an 11% rally earlier in the year. We hit the June lows and then had a 17% rally, which again rejected, and we fell again to new lows. And now we're currently in a 13% rally. And we're touching on this pretty significant trend line that is really overshadowing this whole entire bear market. And a lot of times when the market gets to these big inflection points, we know that the market is either going to move up pretty aggressively or back down pretty aggressively. So this is a very important point in the market. We know that we can either break out here and the bear market can be over, or we could reject off this trend line again and see some more troubling times ahead. So one thing with this current rally that we're in, the internals are telling us something a little differently. So on this chart, you have the 200-day moving average charted in red, the 100-day moving average charted in blue, and this is the S&P 500, which is the US large cap index. And as you can see, for most of the year, these moving average lines have been moving down pretty significantly, and the S&P 500 has held below those moving average lines. So moving average lines are essentially just the average price of a stock plotted over the last amount of days. So the 200-day moving average is the average price of the S&P 500 plotted as a line over the last 200 days, and the 100-day moving average is the same. So the 200-day average, being a little bit longer time frame, is a little bit slower to react. So we know that the 200-day moving average is a really important line for longer time frames. And then the 100-day moving average is a little bit shorter term, which tends to react to trends a little bit quicker. So as you can see in this market rally that we're in right now, the stock market price has risen significantly, like I said earlier, 13%. And we actually closed above that red line, the red line being the 200-day moving average, which is a really significant achievement for the stock market. If you look back in the June rally, we crossed the 100-day moving average, but we didn't quite cross that 200-day moving average, basically telling us that this rally is going to fizzle out and we're going to head back down. So one other thing to notice throughout this whole bear market is the slopes of these lines have been downward. So you have the red 200-day moving average sloping down, and then you have the blue moving average sloping down pretty significantly. But as of November, you've started to see that blue 100-day moving average line start sloping up a little bit, which that is a really good sign that at least the medium-term trend, not quite the long-term trend yet, is starting to change and starting to move in an upward direction. Another thing that we look at is new highs. Throughout this whole bear market, you've seen new highs of individual stocks falling and falling. So on that top bar chart there, we have the New York Stock Exchange Composite, which is every single stock on that is traded on the New York Stock Exchange, which is a really good barometer for the whole entire market. And then below that, we have the S&P 500, which is the 500 largest US stocks. So as you can see through this bear market, the new highs have just been trending down and down and down. Even in the June rally, you didn't see much of a tick up, but through the September, October, November, December period, you're starting to see these new highs being made, which, you know, the S&P 500 is just an index of individual stocks, and the index can't go up unless the individual stocks are increasing and making new 52-week highs. Another thing that we look at is the percentage of the S&P 500 stocks that are over their 200-day moving average. That's that longer term trend line. So this right here charts the percent of stocks of the S&P 500 that are over their 200-day moving average. Right now, we're right around 61, which is more than half of the S&P 500 is over their 200-day moving average, which is that long-term trend. If you look at the June rally, that was a 17%, pretty significant rally. We touched 50% and then fell right back down off of it. So during that June rally, half of the stocks in the S&P 500 weren't even trending upwards on a longer time frame. And now that's a little bit of a different story. We're above 60%, so there's a lot more stocks participating in uptrends than there were in the previous rallies.
Yeah, I think one other important point about that June rally is you see that we barely touched 50% on the 200-day, but the absolute value of the S&P 500 during this rally was actually higher than where it is right now. So I think it's important when we talk about breadth and internals, the levels don't necessarily have to be higher, but it's kind of what's happening underneath the surface that's potentially building the base for a better outcome.
Yeah, absolutely. So, and why we focus on the 200-day. So this chart shows the S&P 500 back to 1950, and it shows those green dots are the S&P 500 closing above the 200-day average for the first time in 6 months or longer. So it's been about 7 months that we've been below the 200-day moving average. And since we just crossed it recently, that's plotted on the chart there. And as you can see, just by the eye test, a lot of these instances are near pretty significant market bottoms. Now, they're not really right on the bottom. They don't perfectly bottom tick the market. But as you can see, in most cases, if you are a buyer at a point where the S&P 500 crosses over the 200-day, you're in pretty good shape. Some of the pretty big outliers there are 2000. That was a really tough year for the markets. The tech bubble popping. You had a signal trigger stocks closing over above the 200-day moving average, and then the stock market as a whole continuing lower before another one fired and the rally afterwards. So it's something we definitely pay attention to. It's pretty significant. It's not a surefire thing, but it's one more tool that we use to determine where the market's going next. So this chart right here shows the number of days without the S&P 500 reaching a prior high. So we've been in this bear market for the whole entire year. It's felt like an extremely long time. But as you can see, there are instances where it takes a very, very long time to get back to new all-time highs. Right now, from where we're at right now, to make a new all-time high, the S&P would have to rally about 22%. So there's many instances where, we have a pretty, significant pullback and get back to new highs pretty quickly, 2020 being one of them. But you do have instances like the 70s, the tech bubble, the great financial crisis, that show us that these really tough times can go a lot longer than we think. The market doesn't necessarily have to keep going down, but it might take a while to get back and regain those previous highs. So with this a bear market, we have seen the fastest derating in history of the S&P 500 based on PE ratios. So PE ratios are price to equity, which is a commonly used ratio to determine the stock market's valuations. So if you look right now, back at the end of 2021, we were right around 28 on PE ratios. They have fallen significantly with this bear market. That black line there is about the long-term average. So right now you'd say we're pretty close to average PE ratios. In a normal market environment, you might say, hey, we're at average PE ratios. It looks pretty good. Now we can really go in and buy stocks because we're at long-term averages. But when you have the backdrop of a potentially slowing economy, you have the Federal Reserve raising rates, you have inflation, you might look at this and say, I think I want to look for something a little bit cheaper. And that's why most of our focus on the equity side has been towards value and dividend paying stocks. So, some of those areas of the market, the PE ratios are much lower. Cash flowing companies that are paying good dividends that are rising. That's where we've been focused. And we've been lowering the PE ratios of our portfolios by doing that. So 2020 has been or 2022 has been a really 2022. 2020 was
2020 was a pretty bad year too.
So 2022 has been a pretty rough year in the equity markets. We're down 17-18% in the S&P 500, which is a pretty bad year, but we expect those to happen. The thing that has made this year feel really, really painful is the bond returns. So interest rates rising so fast, you've had bond returns down at minus 10%. And there's only really 3 instances in which bonds really haven't insulated equity losses. That being 1931, 1969, and now this year. So, we're calling this the 100-year flood. It's a pretty tough environment. Equities have been hit pretty hard, but bonds, the thing that are supposed to really insulate your portfolio, haven't really done their job. So I think Doug's going to go in and talk to us a little bit about the fixed income side and what we're seeing right now and what we're seeing going forward.
Yeah, thanks, Dan. So I think a lot of what Dan covered, on the equity side, speaks a lot to what I would say is more of a short-term outlook. What we're looking at right now in terms of direction, both into the end of the year and then maybe a little bit longer term, and Mike will touch on that in a little bit more detail at the end. But I want to focus on the fixed income side and then dig in a little bit to what we would call the most predicted recession in the history of the world. And we'll kind of show why in a little bit. But so here you can see we've got the entire Treasury yield curve from the 3-month yield to the 30-year Treasury yield. And those are all of these colored lines here. So I don't know that it's important to delineate one over the other. I think the kind of pattern is what makes this chart. Obviously this goes back to December 2020. So you've got rates that are essentially flat across the board. You've got your short-term rates that were essentially zero. And then you have this stair-stepped black line. So this is the core PCE inflation reading. So a lot of people, they hear CPI and they think inflation, and that's kind of the main inflation gauge that is kind of disseminated in the financial media. But the Fed, who is the one who controls the short end of the curve in terms of raising rates to try to combat inflation, they're really paying attention more to this number, this PCE number. And they want to see this ultimately around 2%. Well, right now, as of September 30th, it's hovering right around 5.5. And historically, in order to we'll say, get inflation back to where they want, the Fed has had to get the short-term rates above this black line. And sometimes it's taken, a very short amount of time, sometimes it's taken a longer amount of time. But their ultimate goal is to get this black line below these colored lines. So the question we have going forward is this black line going to come down on its own and allow the Fed to not raise these rates as much? Is this line going to have a rebound and come higher? And are these rates going to have to move higher? Or is it just going to kind of go sideways and these rates need to come up a little bit? Because the one nuance on here that I will point out is the fact that you start to see a little bit of a cluster go down right here. So these are all the short-term rates trying to come up and meet this line as the Fed tries to combat inflation. But now all of a sudden you have the longer-term rates saying, wait a minute, we trade off of economic growth and we're sniffing out a slowdown eventually. So we don't think that you're ever going to make it up here for long enough to matter. So you're starting to see a little bit of a divergence there. Now, cumulative Fed rate hikes can take a very short amount of time. They can take a long amount of time. The current cycle that we're in right now is projected to be around 300 days, so to speak. Doesn't mean it has to be, could be longer, could be less. But if you look at some of the historic rate hike cycles that have had high periods of inflation, the ones that stick out, obviously, 1980, very aggressive, very short amount of time. 1973, kind of right in line with what we've seen right now. And then you've got 1976, which started off very slow and deliberate, and then all of a sudden ramped up at the end. So as we see the current cycle here, we hear a lot of talk about, the most aggressive rate cycle in history and some of these terms. And I don't know that those are necessarily accurate. But what I do think is different from this cycle is that these other cycles didn't start from a level of zero. So, a cumulative raise of 10% off a starting point of 4 or 5, maybe wasn't as big a shock, but when you're coming from zero all the way up to 5%, that's going to have a lagged effect at some point. And the question is, when is that actually going to take place? So I mentioned recession. So this, again, is the most anticipated recession in history. So this chart goes back to 1968. It shows the probability of recession over the coming 12 months based on the Fed's survey of professional forecasters. And you'll hear a little bit more about professional forecasting at the end, but you can see that this recession is significantly more likely, according to these folks, than at any other time, and by quite a large margin. So one thing that we've learned in the financial markets is that when everyone believes something is going to happen, usually something else happens. Now, we're not saying that that's necessarily going to take place, but the concern about a recession here, I think, is shared by a lot of people. Now, the question is, does the data back that up yet? Well, I think what you're going to see over these next several slides is, at least right now, there's a lot of conflicting data points that would lead us to believe if we are going to have recession, it's not going to be in the next 2 weeks, maybe not even in the next 2 months. But let's take a deeper dive here. So you've got two charts or 2 lines on here. One is the US ISM services PMI. So this basically gauges the strength of the service sector in the US. And then you have the orange line, which gauges the strength of the manufacturing sector in the US. So the general rule here is when these are over 50, they're in expansion. When they're under 50, they're contracting. So usually, for the most part, there's some level of agreement here between these 2 indicators. Now, this goes back all the way to January 2020. But what you'll notice here is recently you've seen a divergence. You've seen the manufacturing survey drop under 50, showing a level of contraction, albeit slight contraction, still in contractionary territory. But the last reading, you had the service sector spike up, breaking its downward trend and going into an area that is very much still expansionary. So again, conflicting signals here from 2 of the major sectors in the US. Now, looking at leading economic indicators and how those change year over year. So we showed this chart in our last webinar. So you may have noticed the date August 31st, 2022. So the data is a little bit old. But what we can see is with these gray bars, almost every time you've got the leading economic indicators going down and reaching a level that meets or crosses this orange dotted line here. So when we looked at this back at our last meeting and had the data from August, you can see that the line was definitely sloping down, but it hadn't quite reached that dotted line. Now, fast forward to the data as of Halloween, and what do you know? Those leading economic indicators have now crossed below that line where the average start of recession is. So the last chart we looked at, we had kind of two conflicting data points there. This one with the leading economic indicators would point that those conditions are deteriorating and getting closer to what we would normally see at the beginning of a recession. Now, what's the one thing that everyone focuses on for recession? Well, you need negative GDP growth. So the Fed's estimate of GDP for the fourth quarter is well above zero. It was recently upgraded to, I believe, 3.4, 3.5. So that number is significantly higher than most of the blue chip forecasts that we see down here. And even in this kind of confidence interval, this bar continues to kind of drift higher. So if here's the Fed and their best thinkers trying to say, okay, what does the GDP forecast look like for the fourth quarter? And this is a pretty good number in the context of everything, and not really showing any signs of recession. One of the main things that will happen during a recession is unemployment will spike, and the unemployment rate will spike along with that. So going back to the late 40s, this charts the unemployment rate in the US with the blue bars showing recessionary periods. And pretty much without fail here, you can see that every recession has a spike up in the unemployment rate. Now, here you've got the massive COVID spike, but here we are all the way down here. And there's just a tiny blip there, but nothing significant to where you would look at the unemployment rate jumping and conclude that you're going to see a recession is imminent. And we've talked a lot about all the employment loss from COVID. Well, we've actually recovered everything that we lost during that time frame, and are now back to, I guess, if you want to call it, pre-COVID employment levels, and even exceeding that. And it's been a pretty swift recovery compared to some of the more deep recessions that we've seen. So the Great Financial Crisis in 2007, took almost 70, 80 months to get back to full employment, where we've done that in almost 30 months here. So the economic indicators are kind of toying with each other here, or not really toying, but in a little bit of a disagreement. Whereas what's the bond market telling us? Well, the bond market, based on the shape of the yield curve, and in this case, we're going to use the 2-year and the 10-year as the reference points. The yield curve is extremely inverted right now. And all that means is that the yield on the 2-year bond is higher than the yield on the 10-year bond. And as you can see, all the gray bars on here are preceded by an inverted yield curve. And I think the important thing to point out here is the timing of all this is not necessarily clear. You get the inversion, but then the recession actually doesn't start happening until that curve steepens rapidly. And that's basically based on the idea that the market begins to price in that the Fed is going to have to cut rates to stave off inflation. And as of now, they're really not in any hurry to begin to cut rates, especially when they feel like inflation is too high. So we've got a really, really deep inversion here, similar to the one that we saw in the 1980s. And sure enough, this was also the time that we've had pretty high inflation. So if we were going off the inversion of the yield curve, I don't know that it's screaming through a megaphone recession, but it's speaking at a pretty high volume, saying that recession is going to be in the future. Now, I created this chart kind of as an informational piece on what duration is and kind of how it affects bond prices. My colleagues have recommended that we just leave this as it is. And if anyone wants to screenshot and or come back to this in the future to learn more about duration, feel free, but we're not going to spend a lot of time on this so I don't put the audience to sleep, so to speak. So Mike, we've talked about the possibility of recession going forward. Inflation still remains a problem, but have we reached a level of peak inflation, and is that starting to come down? And if it is, what might that mean for both equities and bonds?
Boy, have you come to the right place to get the answer to that question. So inflation. Inflation is really what got us into this mess to begin with. And just as a bit of a refresher, the basic definition of inflation, if we go back to our old college textbooks, is quite simply too much money chasing too few somethings. We learned that it was chasing too few goods at the time, but it could also be chasing too little labor. And that's one of the issues that's of a fair amount of concern. So where did a lot of the money come from? If you go back to the transfers of funds that happened during the COVID period, there were about $2.5 trillion that were transferred to the general population. We learn regularly, it's been reinforced recently, a lot of that money was stolen, but it was still, it's still out in circulation. And so overnight we had too much money. And there's still about $1 trillion, or maybe from what I read, maybe even closer to 1.3 or 1.4 trillion dollars of that still left on personal balance sheets. So people and businesses, for that matter, are flush. When inflation sort of kicked off, we all remember the supply chain stories and the pictures of ships floating around off the port in Los Angeles and so forth. We couldn't get our stuff. And while a lot of those issues have been worked off, as Doug was showing some PMI indicators recently, services are now pretty robust. And so the story goes, we still have too much money, but now we're trying to travel and go out to dinner and scratch all those itches that we couldn't scratch during the COVID times. And one of the big challenges now with what the Federal Reserve is doing in its battle against inflation, in this whole conversation of whether or not we're in a recession. We did have a couple of quarters back to back earlier this year that would have technically met the sort of textbook definition, although in grand scale, there's a magic group of the secret committee that meets in private and then decides a year or two later whether we've had a recession. But the reality is, who cares what you call it? We had basically a period of very little or no growth. But the outlier here, Doug showed a slide a few minutes ago that unemployment goes up, has gone up almost always pretty dramatically with the onset of recession. Yet we have essentially almost record low unemployment now at about 3.7%, which challenges the notion of what, again, I will stay out of the weeds with the jargon, but there is a NAIRU rate, which is a natural level of unemployment, not the same thing as a NAIRU jacket, which I will confess I owned one, but I never actually wore it in public. It never came out of my closet. But that rate, and it's a moving target, but economists think it's somewhere between 4 and 6%. So what that says is that when inflation falls lower than those thresholds, it is inflationary. And the problem is in seeking out peak inflation, because it will bounce around a little bit. We've seen a little progress on peak inflation lately, especially as it relates to goods pricing. Obviously, gasoline has fallen a lot. Gasoline now is about, I think it's within a penny of where it was a year ago, after the intervening spike. So there's been a lot of relief in that regard. But at a 3% unemployment rate, what the government officials are concerned about is the potential for a wage price spiral. So to the extent that there's a labor shortage, the price of labor gets bid up. Remember, we've got too much money chasing too few somethings, in this case, labor. And to the extent that wages rise, then we now have a self-fulfilling cycle where there will be more money again chasing too few goods. So the challenge here is, as this slide indicates, is to determine whether or not peak inflation is behind us. Certainly, we've seen that tip over just a little bit. The concern is that it will come back again, which is why the Federal Reserve is basically saying they're going to raise rates higher and keep them there for longer than a lot of people expect. Again, they're jawboning the problem, trying to get the markets to cooperate and help them solve it. But if the markets don't cooperate, then we can expect them to do that. The big takeaway from this slide here, though, is that once we have reached peak inflation, with just a few rare exceptions, the markets have done reasonably well. Understand that the markets would have corrected before these events. So you had your bear market, and now you're expecting a market recovery, and you can see that by and large, the markets have obliged. The big standout here is 2008. Remember, that's the real estate crisis, and that was a very different recession. Without going into all the details, typically recessions are income oriented. In other words, inventories build up, business slows down, and we have an income recession because businesses lay off employees while they work off inventories, things of that nature. In 2008, of course, that was the banking crisis, the real estate crisis, and what we had essentially was collateral was vaporizing and the system was imploding on itself. So that was a very elongated problem, let's say. So the moral of the story here is once we get peak inflation behind us, we should be in decent shape, realizing we have to also clear the recession risk. This side is a very well kept secret, and after months of research and consulting all the best national experts, we put our heads together and we can now definitely say that things will either stay the same, they'll get better, or they'll get worse. So the challenge here then with rates is which of those outcomes are we going to see? So Doug and Dan have already outlined a number of the forces that are kind of pushing against each other. The current scenario that we have now, which would essentially say things remain the same, which is we keep full employment, the Fed continues to fight inflation, and people continue to worry about the pending recession that the Fed is going to be bringing upon us. So if that happens, we can expect, so if you look at the little teeter-totter, think of short-term rates on the left and longer-term rates on the right. If that happens, the Fed's going to keep pushing rates up. They're going to raise rates again here next week, and we can expect to see those rates tick up even a little bit higher. And as that happens and the markets continue to anticipate recession, we can expect the longer-term rates to stay low or lower, and that's the inverted yield curve that Doug was describing earlier. And of course, the more that gets entrenched, the more that does really signal that a recession is in the cards. We can have a sort of the soft landing scenario, the no recession condition, and this is sort of the Goldilocks answer. Things basically stabilize from where they are. From an economic perspective, inflation continues to work itself down rather than having big recessions in order to reduce employment. Basically, employment works itself off over a period of time by people not coming into the job market as opposed to having to fire people. And then the third scenario, in that situation, can assume that rates will stay about where they are, and longer term rates, the inversion will go away. So we'll have longer term rates begin to sort of approach their natural condition. Think of walking.
Hey, Mike, I'm just going to interrupt you real quick. Your sound's kind of going in and out. So I think we're going to have Maureen maybe run you some headphones to see if we could fix that issue.
All right.
So just real quickly, I'll finish this slide here while she tries to grab those. So as he was mentioning, with the non-recessionary environment, we could have rates return to kind of a normal sloping yield curve where you've got the long end of the curve kind of adjusting back up in order to solve the problem of where we are now. So if that's the case, you're going to want to hold things like cash, corporate bonds, even high yield might even perform well in a situation like this. And kind of the last issue that we would run into is recession. And there's Mike back, so I'll let him finish this.
So, first of all, is this any better?
Yeah, it is a little bit.
Okay, wonderful. So how long was that going on?
Just a little bit, long enough to where I was hoping it would go away.
Oh, okay. And I was distracted for a minute, so I apologize. Where are you on this slide?
So we're going over the recession portion
right.
of this scenario.
So if the I won't say if the Fed gets what they want, because I don't think anybody wants recession, but if this is what it takes in order to bring recessionary forces down, then what we can expect are interest rates on both sides of the equation, but both sides of the fulcrum to decline. That would be bad in the short run, but ultimately it would clear the decks and then create the conditions for recovery. So why is this important? So there are sort of going back to the basics, there are three things that are really important in, you can, I'm not quite there yet. Yeah. There are three things that are important when it comes to moving things forward with the markets. One are earnings. And of course, in a recessionary environment, earnings are not going to do well. And in most recessions, they actually decline. So you hear us talk a lot about, earnings are being announced next quarter and hopefully they're going up and that should support rising prices. Well, declining earnings are bad for prices and generally drives them down. Interest rates are, when you think of pricing models, interest rates are used to discount those earnings and the expectations for earnings, which brings potentially prices down further as interest rates rise. So in a recessionary environment, we have earnings down, that's bad. We have rates potentially down, that's good for the discount model. And then the final component that's relevant is sentiment. So investor sentiment is sort of what, the people who have their fingers on the buy and sell buttons interpret the information based on whether they're optimistic or pessimistic. And of course, recession brings on pessimistic sentiment. So if we get to that point, then we would expect markets to decline further before they would improve. And that brings us to the fact that with those being the possible outcomes, how do we deal with that? Well, you have to play the hand you're dealt. There's nothing we can do. The Fed's definitely in the driver's seat. So in that case, we continue to emphasize, and for long-term clients, for super long-term clients, more than 30 years ago when we started the company, we did it on the back of a investment philosophy that focused on rising dividends, companies that pay rising dividends. That's good for a number of reasons. For one, for building financial independence, it creates a regular stream of growing income, but also very important in times like this, it creates stability in tough times. This slide breaks down the performance of two different dividend indices and then sort of the overall market looking by the S&P and the NASDAQ. And you can see that the two dividend indices, the first, this is a real life exchange traded fund that's in our portfolios, is actually up this year, believe it or not. It's hard to think that there's a segment of the market that's actually positive, but it is. The second is down only modestly at just shy of 3%. Contrast that with the S&P down a little over 16% and the NASDAQ down nearly 30. So that there are big differences. We expect, based on the scenarios that I've just outlined, so of those three scenarios, our base case assumption is that we're going to be moving forward in an environment that's a lot like the one we've been in. The Fed is likely going to continue to fight that strong employment market. And that means they're going to have to continue to raise rates a few more times likely and then hold them at a higher level. That means that there's going to be continued pressure on equities, and companies that can generate growing and rising income are going to be valuable. So we continue to keep dividends as a leading item in our portfolios. Setting that aside as a separate issue, we're also focused on where we think the best value is, because what's going to happen is when the recovery occurs, when we get to the other side, you want to own asset classes that got to the best valuations during the correction. And so what we're doing now is looking seriously at areas that we believe are washed out and are ready to rebound when the turnaround comes. So these are actions, in this case, small cap stocks. We have not yet loaded up on them, but we think that this will be a top performing asset class when the recovery begins. What this chart shows is sort of the valuations when you look at price earnings multiples. Dan talked about PEs a little bit earlier. You can see that they are well below average and pretty much at the limits they've been going back to really 1990. So historically we're about at the historical limits again. The spring is wound tight. Small cap stocks tend to do well with other higher beta or other higher volatility asset classes once the Fed reverses policy and growth begins to come back in the economy again. Setting small cap stocks aside, you've heard us talk about value stocks versus growth stocks in the past. Value stocks are not necessarily, they're not just cheap stocks. They tend to be less expensive as a group, but they tend to have a different set of fundamentals. They tend to have solid balance sheets, steady earnings, not necessarily earnings that are ramping up quickly. That would be a characteristic of growth companies. But again, just good, solid, stalwart type companies. They tend to do well. Again, this is a relative chart, but they tend to do well relative to growth stocks, particularly in rising interest rate environments. Remember, I mentioned earlier when I was talking about earnings, sentiment, and interest rates, that one of the big factors about interest rates, besides simply being a competitor for other investments, is that it's a key component in discount models which value different asset classes. And because a good portion of a growth stock's value comes from its assumed growth in earnings in the future. When you discount those at higher interest rates, as I mentioned, the earnings decline. That's not the case for value stocks, which tend to be steady earners. And so in a relative world, if we're looking at a situation where interest rates are going to rise, then value stocks should outperform. These cycles have existed for eons. They tend to last for extended periods of time. You can see from this chart the extended period of value outperformance. Then at the end of the financial crisis in 08 and 09, when the government started lowering interest rates and providing stimulus, growth stocks outperformed. We're likely now at another similar inflection point going the other way, which will likely begin the value outperformance cycle again. So I just want to draw your attention to the little carve out on the side. These are ratings for a variety of value observations. I want to mention this because so often people simply default to just a price earnings multiple, and that can be tricky because there's a numerator and a denominator, and sometimes stocks are the cheapest when their PE multiples are the highest because the earnings have fallen. So we want to look at a broad spectrum of value observations or value indicators in making these decisions. Also, in an area that has one of these cyclical, long-term cyclical observations where value is just shining, and again, looking for a trigger event, are international securities. You can see from the chart on the right that, again, similar to that we just saw with value, there was a long period when international stocks outperformed US just about the same time at the end of the financial crisis, when our governments intervened the most. The US stocks have outperformed radically, and you can see just at the rightmost edge of the stock that although we haven't exactly crossed one of Dan's trend lines yet, you can see that we're pushing up against it. And again, there are a lot of outside forces, currencies, things as fundamental as the war in Ukraine and the impact that's going to have on Europe's energy needs this winter. But this is a beach ball that's being held below the surface, and it's ready to pop up. If you look at the chart on the left, you can see that these are about as attractively valued as you're ever going to find, and it's really just a matter of identifying a fundamental the time when the fundamentals support making this addition. Right now, we do have about 10% of our equity exposure in foreign securities. We would be hoping to be able to increase that again when the fundamental backdrop gives us that window so we can capitalize on these very impressive valuations. So it's prediction time, and of course this is very important information because now you can take this and go make all of your plans for next year and invest accordingly. What this chart shows are the 2023 predictions. So these are all of the biggest investment brokerage houses telling us where they think the market is going to be at the end of next year. Realizing that at lunchtime today, the market was at about 39.60 to give you some reference point. So for example, Morgan Stanley thinks that the market's going to finish just right around where it is today. And you can look down at the chart and see the rest of these estimates. You can see that most of these estimates don't call for much change. Some call for even lower positioning. This demonstrates sort of the overwhelming belief that the Fed will wind up slowing economic growth, making sentiment worse, driving earnings down, maybe lower, but certainly below where estimates are today. So, but at least we know with certainty what's going to happen now because we've got all this information. Or do we? So here are the institution's forecasts from last year. And you've seen this quote from me before. I slip it in whatever I can because Niels Bohr was a Nobel Prize winning physicist. He's sort of the father of the atomic age. And his quote here is, prediction is very difficult, especially when it's about the future. This again gives us the best and brightest minds in the world at the beginning of 2022, telling us where the markets would be today. If you add them up and divide by the number of forecasts, the average miss is about 26%. So we have the blindfolded chimp throwing darts at the stock page over on the right. That's pretty much what this is worth. So the answer to the question is, are these predictions useful? The answer is no, they're not. It's much better to take a longer term view and react to information as it's safe and knowable, which is exactly what we're trying to do. So, what is our position and what are we doing? Well, I think you've gleaned that there is no clear there is no clear indication yet of whether we've crossed the brink. Certainly, we've endured bear market experience so far this year. However, these cross currents or crossroads are increasing the chance likely of more volatility. That means stocks moving higher and lower. You've seen that just even in the last week. Last week, Chairman Jay Powell gave a speech, I believe it was last Wednesday, indicating that he might be tempering interest rate moves. In other words, they've been going up at 75, 0.75% every time they raise interest rates. He suggested that maybe that might drop to 50 basis points. In other words, maybe we've seen peak inflation and he can start to dial it back. Then we got a very good employment report on Friday. This is in the world where good news is bad and bad news is good. Markets didn't like that because it suggested maybe the economy was stronger. Again, that's that whole employment spiral, wage price spiral issue. And markets fell. So we're sort of in this tug of war where we're trying to get some direction of which of those is going to win out. Seasonality. So everybody's heard the term Santa Claus rally. We're in that period of time where between now over the next couple of weeks, typically these are good weeks for the markets, taking everything, if we take everything else out of the equation. With all that said, we are effectively neutral in our allocation. The amount that we allocate to equities is right at the neutral targets. But as we've indicated, we also are overweight to value and overweight to dividends, and that has helped this year versus benchmarks. We continue to hold on the fixed income side, continue to hold a mix of cash, very short-term bonds, along with some of our regular core positions. What that does is it brings down the duration, that thing that we wouldn't let Doug talk about. But essentially, what it says is if you've got longer duration and rates go up, you're going to be hurt. So we've shortened duration so that risk is minimized. International exposure may increase. Again, we recognize the very good valuations there. Just looking for the fundamental smoke to clear so that we can take positions. We're looking for this sort of year-end Santa Claus rally. It may materialize. We did take our tactical underweights and put them back into the portfolio at a good time. So we do have profits that we would want to protect if that rally fails to materialize. At a grander scale, if recession does begin to show the whites of its eyes, we would likely tactically reduce our equity exposure, again, expecting there to be a pullback and would potentially shorten up that magic word duration as well during that period of time. Final slide. The Fed's running the show here. They're at the helm, and there's this notion of a terminal rate. How far are they going to take rates before they quit? That really just depends on whether inflation has peaked or not. Again, on a short-term basis, we've seen some signs that possibly it has, but there's a lot of things that can get sideways in the world, and it's too early to declare a victory there. And even if inflation has peaked, there's also the issue of how sticky it is. Remember, the Fed desperately wants to get this number. They would tell you down to 2%. We think they would settle for something higher than that and take their foot off the brakes. But something does have to happen, and it hasn't happened yet. If recessionary conditions do surface, that would suggest more bonds. Again, if recession hits, then when we looked at either side of that little fulcrum, interest rates would likely fall on both sides. The Fed would be at that point trying to stimulate the economy to manage the recession, and longer term bonds would likely decrease as well. And of course, that's good for bond prices. We saw the inverse of that this year when the Fed jacked interest rates up very quickly and bonds were hurt. Non-recessionary, that basically that could be a repeat of what we've seen so far this year, although a lot of the stock damage has been done. If things are static, we'd have to see a change, which would either be drifting into recession, we just talked about that, or if it turns out that the Fed has navigated this magical soft landing, then we would expect things to get better from there. That information is just simply not available just yet. From our perspective, the base case that we're operating from is that the Fed is going to continue to push, growth is going to slow. Whether that is ultimately declared a recession or not, we don't know. Quite frankly, we don't really care. It doesn't change the things we would do. So the plan for now is to be somewhat defensive, hold our equity exposure neutral unless we do actually break into recession, but keeping the particular asset classes that we're utilizing as those that should do relatively well in a slow economic environment. Again, we've highlighted those there, the value and the dividend paying equities, and we would continue to underweight the more aggressive positions and the more growthier positions until we can get declining interest rates so that we have better capitalization rates for valuing those asset classes. And I think that's the fat lady singing.
Yeah. So I think we've got time for one question here.
Perfect.
Really a question about high yield as an asset class and how that might perform. So I think there's kind of two paths for high yield. And we mentioned it in the teeter-totter slide. If you get into an environment that we somehow reach a soft landing, high yield will probably perform pretty well. On a relative basis, the yields that you're seeing compared to the past 5 years are pretty good. The spreads over treasury yields are not historically attractive, but that doesn't necessarily mean that high yield can't perform well in an environment where economic growth remains solid. Now, the flip side of that is if you do get into a recession, I would 100% expect high yield to struggle, as it's much more of a credit related product. Historically, it's high yield's done poorly in almost every recession we've seen, but out of that struggle could come some significant opportunity if eventually yield spreads, and when we say spread, it's just the differential between the spread on the high yield bond and then what the corresponding treasury yield would be. If those get in the 8, 9, 10% or higher ranges, that's usually a good time to start to take a serious look at overweighting an asset class like high yield. But high yield is like anything else. It's one of those things where the best time to buy it will be when nobody wants to touch it. So, but for now, I think high yield is okay. But if we were to go into recession, it would probably be an asset class that I would expect to underperform. So Mike, I think that's it.
Okay. So that does it for today then. Of course, if news breaks, we'll be back. Otherwise, expect to see us again in early January. Don't forget that we will be doing the St. Vincent de Paul coat drive again this year. We'll be starting that shortly after Christmas. That's the time that their donations fall off, and we've been successful with that the last couple of years. We have collection barrels in our office. We're happy to pick the coats up. Anything that supports that is great. It's been a big success, as I said, the last couple of years for us. If you have any questions in the interim, reach out to us, call your advisor if you need anything. We'll be here. And that does it. Merry Christmas, everybody. Bye-bye.